Welcome back to the Deep Dive. Today, we are strapping in for an intensive look at the first quarter fiscal 2026 earnings call for Winnebago Industries.
Yeah.
For anyone who follows the RV and marine space, this was, well, it was probably the most volatile release of the entire quarter.
It was explosive. And our mission today is really to move past that initial shock, the big pop and then the fade.
Right.
We want to distill the key financials, the strategy, and what it all means. Because there's this huge tension between amazing internal execution and, well, a lot of skepticism about the outside world. We need to figure out how durable these results really are.
Okay, let's get right into it then. We have to start with the headline beat because the numbers themselves are just, they're staggering.
It was a fundamental misread by the street. Just a phenomenal performance. Let's start with profitability. Adjusted EPS came in at 38 cents.
38 cents. And the consensus was what?
A meager 13 cents. So that is more than double the estimate. That's not a small beat. That's a massive gap.
And you don't get there without a huge top-line number as well.
Absolutely not. Revenue landed at $702.7 million. The consensus was sitting way down at $629.9 million. So they beat by nearly $73 million. That's 12% year-over-year growth.
And critically, they got back to actual net profitability.
A huge psychological win. Net income was $5.5 million, coming from a loss in the prior year. For investors worried about these cyclical companies, seeing that positive number is a big deal.
Okay, so they beat the quarter, but then they immediately turn around and raise guidance for the whole year.
That's the real sign of confidence. It tells you this wasn't just a one-off. They upped the net revenue range, adding $50 million to the low end. It's now $2.8 to $3.0 billion.
And what about EPS?
That range expanded too. Now they're targeting $2.10 to $2.80. When management raises that aggressively, they're signaling that their strategy is working, even if the macro environment is, still bumpy.
So let's get into that. The how. Where did that 12% growth actually come from?
It was a very balanced attack, which is a great sign. The biggest segment, towable RVs, had the strongest growth, up an impressive 15.5% year over year.
Wow. And towables are the volume driver.
That's the volume. But motorhome RVs were right behind, up a very robust 13.5%.
Okay, so the two big RV segments are firing on all cylinders. What about marine? We know the industry has been soft.
It has. And they came in with modest growth, 2.2% year over year.
Which doesn't sound like much, but in context.
In context, it's a huge win. Management was clear that in an environment where competitors are actually shrinking, any growth at all means you're taking market share. And that's what their Barletta pontoon line is doing.
This all ties back to what they kept repeating on the call, right? This theme of executing the controllable.
Exactly. They aren't just sitting around waiting for the Fed to save them. They're focused on product, on efficiency, on things they can actually manage. And the best example of that is what they're calling the barbell strategy.
Right, the barbell. Let's break that down. One end is all about affordability.
It is. The value focus. They are leaning hard into the cost-conscious buyer. You see it with the Grand Design models, the Transcend, Imagine, Reflection 100 series.
And they have a new one, too.
Yeah, the new Winnebago Thrive travel trailer. It's designed specifically to get that first-time buyer in the door, the person who's really feeling the pinch from interest rates.
So that's the volume play. But the other end of the barbell is where the real money is made.
That's the premium share gain side. And this is the profitability story. They're going after high dollar weighted share in motorized. They pointed to their dominance in Class A diesel. They have a 33.9% market share there now.
That's mostly the Newmar brand, right?
Mostly Newmar. But they're also seeing huge growth in Class B and the Super C categories, especially with the new Grand Design Motorhomes Lineage series.
So they're capturing both ends of the market. And the proof is in the margins, I assume?
The proof is absolutely in the motorhome segment operating margin. It improved by a massive 390 basis points from last year.
Why?
And that is a direct result of selling more of those high-margin premium units. And to be fair, also lower warranty expense in that specific segment. It's a clean win.
That motorhome margin story is fantastic. But, every great earnings report has a but. Where's the friction point here? What are investors worried about?
The friction point is the towable margins.
Yeah.
It's the heart of the skepticism, and it's probably why the stock gave back its gains.
So what's the number?
So towable revenue grew that huge 15.5%, which sounds amazing. But the segment's operating income margin, it only improved by 30 basis points. It's sitting at just 3.8%.
So you grow the top line by almost 16%, but your barely making any more money on each sale. The incremental profit is just razor thin.
Exactly. And there are two reasons for that. First is the mix shift. When you sell more of those cheaper entry-level models, your overall margin naturally goes down.
Okay, that makes sense. It's a consequence of the barbell strategy. But what's the second factor?
Higher warranty expense. And this is the one that raises some questions. Warranty expense for the whole company hit the 3.6% of revenue, which is up 40 basis points just in the last quarter.
So is the issue that they're selling cheaper units that just have lower margins? Or is there a potential quality issue with these new high-volume, cost-sensitive products that's driving up service costs?
That's the billion-dollar question. If those new Thrive trailers are flying off the lots but then coming back for warranty work, that's a double whammy. You get hit on mix and you get hit on cost. It's something to watch very closely.
It definitely is. Okay, let's switch to the balance sheet. How is their financial health looking?
Very disciplined. This is part of that controllable theme.
Yeah.
Cash is strong at $181.7 million, and they generated positive operating cash flow.
And what about leverage?
They've successfully gotten the net leverage ratio down to 2.7x, and they reiterated their target to get to about 2.0x by the end of the fiscal year. They are de-risking the balance sheet, which is exactly what you want to see.
And are they just pushing inventory onto dealer lots to make the wholesale numbers look good?
No, actually the opposite. Inventory turns are at 1.8x, which is just shy of their 2.0x target. But management was clear they are being very disciplined, limiting wholesale shipments unless it's for brand new, high-demand products like the Grand Design motorized line.
That's good dealer management.
It is. And they said aging inventory on dealer lots is lower year over year. So they aren't creating a future problem for themselves with old, stale product.
Let's talk about the forward look, because this is where the market really got nervous.
Yeah, extremely cautious guidance. They said Q2 sales would be seasonally lower than Q1, which is normal, but only modestly up year over year. EPS is also expected to be down sequentially. They're not promising the moon.
And their macro assumptions are pretty grounded, too.
Very. They're only baking in maybe 2 or 3 25 basis point Fed cuts for the rest of the year. They know RV demand is super sensitive to rates. They are not betting on a big retail recovery to save them.
Which brings us to how the market reacted. The stock opens at, what, $47.66, and then it just bleeds all day to close under $44. That's a huge reversal. It must have felt like a punch in the gut for anyone long the stock.
For sure. The market basically chose to focus on the future uncertainty instead of the past performance. That cautious Q2 guide, combined with the towable margin pressure, it just validated all the cyclical fears investors have. The beat was historic, but the market wants proof that it's sustainable.
And the broader industry data isn't really helping, is it? Are we finally seeing that big upgrade cycle?
Unfortunately, no. Management said it themselves. They are not seeing significant signs of people who bought RVs during the pandemic coming back to upgrade yet. The RVIA, the industry association, ticked up its 2025 forecast slightly, but the 2026 forecast is still very conservative.
Okay, but there's one huge wild card here that could be a non-operational catalyst: the tariffs.
This is the silent catalyst. It's a cost that's already baked into their guidance. Management confirmed their entire outlook assumes they continue paying the current tariffs.
But those tariffs are being challenged in court.
Exactly. They are under a broader legal challenge that's headed to the U.S. Supreme Court.
Yeah.
So if that challenge is successful and those tariffs are suddenly eliminated,
it's pure profit that drops straight to the bottom line.
It's a significant non-operational windfall that requires zero effort on their part.
Right.
And I can guarantee you the market has not priced in a favorable ruling on that. It is pure unpriced upside.
Speaking of unpriced upside, it is time for our final segment.
The segment where we must remind you that this is for intellectual consumption only. We are analysts, not your fiduciaries. Please consult a qualified financial professional.
This is not financial advice. We take the key insights from the call and spin up an outrageous but plausible trade. So what's the move on WGO?
We are playing that core tension. The market is punishing WGO for external risks, but management is winning on internal execution and has this potential legal catalyst.
So how do you structure a trade around that?
The trade is this. You go long WGO with out-of-the-money call options, expiring about 9 to 12 months from now.
Okay, why that structure?
The out-of-the-money calls give you cheap leverage to the upside, and the 9 to 12-month expiration gives you enough time to capture a potential Supreme Court ruling on those tariffs.
So that's the bet on the big sudden upside. How do you protect yourself if the RV market just stays soft?
The hedge is a short position on a pure play, lower-end towable RV manufacturer. You find a competitor that doesn't have Winnebago's premium motorized and marine segments to lean on.
So you're isolating the risks.
You're isolating the macro risk. If the whole industry stays weak, that pure play company gets hurt badly. But Winnebago is partially protected by its high-margin segments. This structure lets you bet on their superior execution in the tariff wildcard while hedging out some of that broad market cyclicality.
A very clever structure, a bet on internal strength over external fear. All right, that brings us to our final thought.
We saw a massive earnings beat and raise guidance, all driven by that disciplined barbell strategy, but it's offset by those towable margin concerns and a really cautious view on the retail recovery.
The tension is clear. Management's guidance is anchored in a soft market. They are only focused on what they can control.
Right.
So here's the question for you to think about. Given how conservative that guidance is, and that they've explicitly said the upgrade cycle hasn't even started yet, how much is the market underestimating what could happen if interest rates finally stabilize and that upgrade cycle actually kicks in? Their guidance is based on today's soft reality. What happens to their earnings if the industry actually has a good year in 2026?
That gap between the cautious guidance and a potential recovery is where the opportunity might be.
A fantastic deep dive. Thank you for joining us as we unpack the story at Winnebago Industries. We'll catch you on the next one.